So let's recap this lecture. Bonds, which are simply tradable IOUs, are important instruments in financial markets. Governments, banks, and non-financial corporations are the big issuers of these bonds, which is to say they are the primary entities that use bonds to borrow in financial markets. Households, pension funds, and foreign governments are major categories of owners of the bonds, serving as the creditors to the entities whose bonds they own. A bond promises to repay an amount upon maturity at the end of the life of the loan. The promised repayment amount is called the face value or par value. Most commonly, the bond also promises to pay the holder periodic interest payments or coupons, which are specified as a percentage of the face value of the bond. In most cases, when the issuer first sells the bond's price is close to the face value of the bond, reflecting a yield to maturity that is close to the coupon rate on the bond. The payments that you're promised from a standard coupon bond are completely known ahead of time. So if you hold the bond to maturity, the only risks are those of inflation and default. As long as the bond hasn't defaulted by the maturity date, the face value will be returned to the investor. But the price the market puts on the bond's future payments, or alternatively the yield at which it discounts them, can change over time. So investors who think they want to sell bonds before the bonds mature have to consider the possibility that the value of the bond could be higher or lower when they want to sell. We saw that prices and yields of bonds move in opposite directions. If the yield to maturity rises, that means that the market is discounting future payments more and the bond has gotten cheaper. If the yield to maturity falls, that means that the market is discounting future payments less and the bond has gotten more expensive. Finally, we saw how coupon bonds can be carved up into zero coupon bonds and priced accordingly, as bond traders have done for many years with U.S. Treasury strips. The prices of the strips reveal that the use of a single yield to maturity to price a bond hides the fact that the market usually discounts more distant payments at a higher periodic rate than nearer-term payments. So what have we not yet covered about bonds? First, we haven't gone into the reasons that prices and yields might change over time for essentially default-free bonds like Treasury bonds, and how sensitive such bonds are to changes in discount rates. Nor have we looked at how corporate and municipal bonds that might default are priced, and what drives changes in their prices over time, both absolutely and relative to Treasury bonds. We've also really only considered vanilla bonds. There are a range of other flavors and twists on the theme, including inflation-indexed bonds and floating-rate bonds. Finally, it's important to consider the implications of this analysis for investing in bond mutual funds, or bond exchange-traded funds, or ETFs, which is the way that many individual investors will invest in bonds. Those funds are allowing bonds to mature and automatically rolling over the proceeds into new bonds, so that the cash flow timing you incur is different relative to buying individual bonds if your plan is to consume the proceeds.